The Chancellor delivered the UK budget on 24th of November 2025. The theme this year has been raising taxes and spending more. Unfortunately, if you own and run a small business, this one will hit you really hard. Here are the key announcements you must watch out for as you plan your finances going forward. The personal tax allowance has not changed. This affects you if you're a director taking a salary through PAYE. This allowance has been frozen at £12,570 for 3 more years to 2031. This is not good news because as inflation goes up, more of what you earn will be pushed into the higher tax-paying brackets. This is called fiscal drag, and you may hear this term more and more as people start to realize what is happening. The freeze on employer NI contributions has been frozen at £5,000 a year or £417 a month per employee. This is the point at which you start paying NI for your employees, and it's also been frozen for another 3 years to 2031. As you increase wages to keep up with inflation, this means that a larger proportion of your payroll will be subject to the 15% employer NI rate. If you have a business with a large number of employees, this one will affect you significantly, and it's important to relook at your budget and see how much your total payroll is going to cost you. The national living wage for workers aged 21 years and above will increase to £12.71 per hour. For a full-time employee working 37.5 hours a week, this represents an annual increase of £900. The national minimum wage for 18 to 20-year-olds will also increase to £10.85 per hour, which is an increase of £1,500 for a full-time worker. At the same time, the rate for 16 and 17-year-olds will also go up to £8 per hour. These increases will add to your payroll costs, and if you combine it with the frozen employer NI thresholds, the impact of your labor costs could be significant. If you have a team of employees, you should factor these increases into your pricing and your budgeting strategies for 2026 onwards. Pension contributions used to be a favorite go-to strategy for saving tax. Now, from April 2029, if you do it via salary sacrifice, there's a cap of £2,000 exempt from NI contributions. This means that any pension contributions above £2,000 per year will be subject to national insurance contributions. The Office of Budget Responsibility predicts that many employers will pass this cost on to employees, either through lower wages or reduced pension contributions, but it is important to discuss the implications for your business and for your team with your accountant or your advisor before you take any action. Capital allowances for investments have been reduced. From April 2026, the writing down allowance main rate will be reduced from 18% to 14%. This is a significant change for businesses that invest in capital equipment, as it reduces the amount of tax relief they can claim. The change will particularly impact businesses that rely on second-hand assets and vehicles, as these do not qualify for the new 40% first-year allowance. For comparison, the first-year allowance was formerly 100%, which means that previously you could claim the full cost of the asset in the year bought. Now, it's only 40%. There's a new tax on electric vehicles. This one was a surprise for many, as we have been encouraged for so long to change to electric vehicles for the sake of the environment. There's a new electric vehicle excise duty, which is a 3p per mile for every electric vehicle, reduced to 1.5p per mile for a plug-in hybrid or a part hybrid electric vehicle. There's also a higher threshold for cars that are considered to be expensive cars, costing over £50,000. On the flip side of that, if your company uses electric vehicles or part hybrid electric vehicles as company cars or company vans, you'll face the new per mile tax, but there's also additional support if you can install electric vehicle charging points at your premises. The incentive here is by installing the charging points, you will reduce your business rates relief by 100%, which cuts your premises and your property costs. For owner-managers of limited company, the tax on dividends is increasing. From April 2026, the dividend tax rate will increase by 2%. The basic rate will now be 10.75%. The higher rate will be 35.75%, and the additional rate remains at 39.35%. A similar increase will apply to savings and property income from April 2027. If you're a landlord and your property is held in your limited company, you will face the higher dividend tax when extracting your profits. And if you hold the properties in your own name, the tax on property profits will go up by 2% also for individuals. So there's no running away from it. When it comes to selling your business, it has been tax efficient to sell to your employees, but that has now changed. Tax relief for selling to employee-owned trusts or cooperative structures has been cut from the full 100% relief to 50%. This means if you're selling, you need to account for a bigger capital gains tax bill, so it's important to plan for it. My final update is that HMRC has got new powers. The powers are to increase compliance activity. The idea is for HMRC to tackle the small business tax gap. This is where the government is not collecting the tax it predicts because people are finding a way to beat the system. The new powers allow HMRC to pursue promoters of tax avoidance schemes, to increase focus on the gig economy, to ensure that the minimum wage is enforced, to catch fraudulent traders, and collect unpaid tax. What does this mean for you? It means a lot more scrutiny, perhaps even more brown envelopes than you're used to. But what can you do? These changes require careful planning. I recommend reviewing your financial strategy in the light of the budget. Key things you should consider are how to extract your profits from your company. Look at how you're paying yourself and whether your current mix of salary and dividends is still the most tax efficient. Look at your payroll costs. Work out what the new minimum wage increase and the frozen employer NI insurance means for you and your business, and then review your pricing and your margins to ensure that you can still remain profitable. If you offer the salary sacrifice scheme, prepare for the changes that are coming to pensions and consider what adjustments would be required to make sure that you're not out of pocket. And finally, it's more important now than ever to ensure that your records are accurate, your bookkeeping is kept up to date, and your tax compliant is up to date. These are all things that we can help you with at GHawk Accounting. Get in touch with us and ask for a bespoke tax strategy planning session. But if you'd like to start on your own, scan this QR code and take our free Finance Health Check quiz to uncover the hidden risks in your business, tax saving opportunities. As always, feel free to send us any questions and any comments on how we can assist you in running your small business. I'm here to help you navigate these changes. Feel free to contact us and to book a call to discuss specifically how this budget will affect your business. My name is Lena Oduo. Thank you for watching.